Have you ever wondered why accountants treat leases like loans, even when you never actually buy the asset? Well, that's exactly what we're unpacking today. By the end of this video, you'll understand how to account for leases from the lessee's perspective under IFRS 16, how to measure the right-of-use asset and the lease liability, how to handle subsequent measurement, derecognition, exemptions, sale-leaseback transactions, and how all of that compares to ASPE. And before we dive in, don't forget to like this video, subscribe to Canada Accounting Insights, and turn on notifications so you don't miss future tutorials that make complex accounting topics simple and practical. All right, let's get started. Let's begin by clarifying what a lease actually is. Leasing is everywhere. Companies lease vehicles, office equipment, warehouses, and even entire factories. From a legal perspective, a lease is simply a rental agreement. But from an accounting perspective, IFRS 16 looks deeper than the legal form. It focuses on the substance of the transaction. In other words, is the lessee really just renting the asset, or are they effectively financing a purchase of the right to use it? That's the foundation of IFRS 16. To decide whether a contract contains a lease, IFRS 16 gives us a three-part test. Number one, there must be an identified asset. The asset must be explicitly specified in the contract, and the supplier cannot substitute it at will. For instance, if a company uses a car-sharing service where vehicles are interchangeable, that's not a lease. But if it rents a specific vehicle for its exclusive use, that is a lease. Number two, the customer must have the right to obtain substantially all the economic benefits from using the asset. That means not just the output it produces, but any byproducts or other benefits derived from it. And number three, the customer must have the right to direct the use of that asset during the term. If all three criteria are met, the contract contains a lease. Let's make this concrete. On January 1st, year one, Maple Leasing Corp. purchased specialized equipment and rented it to Aurora Energy Limited for 7 years. Aurora pays $32,000 per year and can buy the equipment for $12,000 at the end of the lease. Applying our test, the asset is clearly identified. That's specialized equipment. Aurora gets the economic benefits from using it, and Aurora directs how it's used. So yes, this is a lease because Aurora controls the use of the equipment for a set period in exchange for cash payments. Now, why is leasing so popular? For lessees, leasing can mean 100% financing of an asset that might otherwise require a large upfront payment. Leasing companies also tend to offer more flexible terms than traditional lenders. From a tax perspective, lease payments are generally fully deductible. However, the lessee cannot deduct depreciation or the interest portion separately. Instead, the full lease payment is deducted, while the lessor claims the capital cost allowance. Lease agreements often include both lease and non-lease components. For example, leasing a photocopier might include both the right to use the copier, a lease component, and a maintenance service contract, a non-lease component. Under IFRS 16, these must generally be separated, allocating payments to each based on their standalone prices. But there's a practical expedient, a shortcut. You can elect to account for both together as a single lease component. This election is made by class of asset and can simplify your accounting significantly. Now let's talk about the initial recognition. At the lease commencement date, the lessee recognizes two things, a right-of-use asset and a lease liability. Let's start with the ROU asset. The ROU asset is measured at cost, which includes the initial measurement of the lease liability, any lease payments made at or before commencement, less any incentives received, any initial direct costs, like legal fees or commissions, and the present value of any restoration or dismantling obligations at the end of the lease. The entry looks like this: debit ROU asset, credit lease liability. Let's look at an example. On January 1st, Northern Tech Inc. leases equipment from Tundra Systems. The annual lease payment is $40,000 for 6 years, payable at the start of each year. Northern Tech pays a $7,000 finder's fee, $10,000 installation costs, and expects to spend $12,000 dismantling the equipment at the end of the lease. Present value $7,155. The initial lease liability is calculated at $204,530, so the ROU asset includes $204,530 plus $7,000 plus $10,000 plus $7,155 equals $228,685. The first $40,000 payment reduces the lease liability, and the journal entry is debit ROU asset $228,685. Credit lease liability $164,530. Credit cash $57,000. Credit decommissioning obligation $7,155. That's how the asset and liability are set up. The lease liability is measured at the present value of future lease payments, discounted at either the rate implicit in the lease if known, or the lessee's incremental borrowing rate if not. Now, what exactly goes into that calculation? Include fixed lease payments, variable payments based on an index or rate, bargain purchase options expected to be exercised, guaranteed residual values expected to be paid, termination penalties if applicable. Exclude unguaranteed residual values, non-lease service components, unless you elected to include them. Continuing with Northern Tech, they guarantee the equipment's residual value will be $20,000, but expect to pay only $15,000. No variable payments, no bargain purchase option, and the implicit rate is unknown, so they use their incremental borrowing rate of 9%. The lease liability equals the present value of 6 payments of $40,000 plus the $15,000 expected residual guarantee, discounted at 9%. You can use Excel's PV function or a financial calculator for that. Here's a quick variation. Suppose Prairie Logistics leases delivery vans, an initial payment of $40,000 plus 6 quarterly payments of $5,000 over 2 years with an 8% annual rate. The PV of those future payments is $28,007. Add the initial payment and the total lease liability and ROU asset are $58,007. Now that we've set up the asset and liability, let's talk about what happens next. After initial recognition, the ROU asset is measured using the cost model, just like property, plant, and equipment. That means cost minus accumulated depreciation, minus impairment, plus or minus any remeasurements of the lease liability. If ownership is expected to transfer, for example, there's a bargain purchase option, depreciate over the useful life of the asset. If not, depreciate over the lease term. Let's see another example. Suppose the ROU asset was recorded at $313,506 for a 7-year lease. The equipment's useful life is 10 years. Because ownership won't transfer, Solaris depreciates it over 7 years, using straight-line depreciation. Depreciation expense each year, $313,506 divided by 7 equals $44,787. The journal entry would be debit depreciation expense $44,787. Credit accumulated depreciation, ROU asset $44,787. Meanwhile, the lease liability is carried at amortized cost. Each payment reduces the liability, and interest is accrued using the original discount rate. If payments are made at the beginning of the year, calculate interest on the balance after the payment. If payments are made at the end of the year, calculate it on the balance before payment. Debit interest expense. Credit lease liability. Continuing with Solaris automation. The initial lease liability was $261,506 at 6.1%. Annual payments are $55,000, which includes $3,000 of maintenance excluded from the liability. The first payment reduces the liability to $225,458, and each year interest builds at 6.1%. A small amortization schedule helps you see the pattern. Interest each year gradually declines, and by the final year, the liability equals the residual guarantee. IFRS 16 provides 2 main exemptions. Short-term leases, 1 year or less. Low-value assets generally under $5,000 when new. If you elect the exemption, you don't record an ROU asset or liability. Instead, you simply expense the lease payments on a straight-line basis. For example, Horizon Design Studio leases a computer for $70 per month for 18 months. Because the fair value of a new computer is only $1,000, it qualifies as low value. So Horizon can just expense $70 per month, debit rent expense $70, credit cash $70. At the end of the lease, several things can happen. If the lease simply ends and the asset is returned, the ROU asset will be fully depreciated and both the asset and liability are derecognized. If there's a residual value guarantee, any payment made will adjust the lease liability and any difference becomes a gain or loss. If the title transfers, either automatically or via a bargain purchase option, the ROU asset becomes an owned asset. You remove the ROU asset account and set up the owned asset at its carrying amount. Debit asset, debit accumulated depreciation, Romanian lei, credit ROU asset. Suppose Williams Industries Limited leased equipment for 10 years with an option to buy for $10,000. At the end of the term, the ROU asset has a cost of $75,000, accumulated depreciation of $50,000, and the lease liability equals $10,000. If Williams pays the $10,000 option, the entries are debit asset $25,000, debit accumulated depreciation $50,000, credit ROU asset $75,000, debit lease liability $10,000, credit cash $10,000. If they don't pay the option, they derecognize the asset and record a $15,000 net loss. On the financial statements, ROU assets and lease liabilities must be separately presented or clearly disclosed in the notes. Disclosures include the nature of leasing activities, maturity analysis of lease liabilities, additions to ROU assets, depreciation and interest expenses, cash outflows from leases, and any adoption of short-term or low-value exemptions. This transparency helps users assess how leasing affects liquidity and solvency. Next, let's talk about sale-leaseback transactions, one of the trickiest areas. This happens when a company sells an asset, like a building, and immediately leases it back. The key question is, did a sale actually occur? If control of the asset was not transferred, for example, the seller-lessee must repurchase the asset, then it's not a sale. Instead, it's treated as a financing arrangement. On January 1st, Aurora Enterprises, Inc. sold its office building to Redwood Realty Corp. for $2 million and leased it back for 10 years at $250,000 per year. The agreement requires Aurora to repurchase the property for $2.4 million at the end of the lease. Because Aurora is obligated to repurchase the asset, control hasn't transferred. This is not a sale. The accounting: debit cash $2 million, credit financial liability $2 million. Each year, Aurora recognizes interest expense and continues to depreciate the building as usual. Now, if there's no repurchase obligation, then a sale has occurred. For instance, Blue Manufacturing sells its building to Rouge Investments, Inc. for $3 million, fair value, and leases it back for 22 years at $134,600 per year with an implicit rate of 5.2%. The building's carrying amount was $2.4 million. The total gain on sale is $600,000, but under IFRS 16, only the portion related to the rights transferred can be recognized. That recognized gain is $252,025, and the ROU asset is recorded at $1,391,901. The journal entry: debit cash $3 million, debit ROU asset 1391901. Debit accumulated depreciation $400,000, credit building $800,000, credit lease liability $1,739,876, credit gain on sale $252,025. The ROU asset is then depreciated over the 22-year lease term. Now let's shift gears and look at how ASPE differs from IFRS. Under IFRS 16, all leases are capitalized unless they qualify for the short-term or low-value exemptions. Under ASPE, leases are classified as either capital or operating. Only capital leases are recognized on the balance sheet. Operating leases are expensed as incurred. A lease is capital under ASPE if any of the following are true. 1. Ownership transfers by the end of the term, or there's a bargain purchase option. 2. The lease term covers 75% or more of the asset's useful life. 3. The present value of minimum lease payments equals 90% or more of the asset's fair value. If any one of these criteria is met, record a leased asset and lease liability. If not, treat it as an operating lease. ASPE also requires executory costs like maintenance to be excluded from minimum lease payments. Use the lower of the implicit rate and the incremental borrowing rate. and the leased asset cannot be recorded at more than its fair value. In contrast, IFRS allows the ROU asset to initially exceed fair value, but it must be tested for impairment. All right, we've covered a lot today. Let's quickly recap the key points. Under IFRS 16, recognize a ROU asset and a lease liability for nearly all leases. Measure them at the present value of future lease payments. Depreciate the ROU asset and accrue interest on the lease liability. Apply exemptions for short-term and low-value leases. Derecognize at the end of the lease or when ownership transfers. And apply special rules for sale-leaseback transactions. Under ASPE, only capital leases are recognized on the balance sheet. Operating leases are simply expensed. If you found this video helpful, don't forget to like the video, subscribe to Canada Accounting Insights, and turn on notifications so you won't miss the next tutorial, where we'll tackle lesser accounting under IFRS and ASPE and see the other side of this story. Thanks for watching, and as always, keep learning, stay curious, and I'll see you in the next one.